All right, we are live with Mackey's Retail Roundup. Spencer Israel. That's Jeff Mackey, the other guy. Is he this way or is he that way? I'm not really sure. I'm not watching. I'm watching you because we're here right now, Mr. Mackey. I guess we're in earnings season. We may not be in like retail earnings season, but we are in earnings season here with the banks reporting today. We have some earnings to talk about later on this week that you care about. We have a CPI number from this morning. We can talk about that. But by and large, how are things?
Yeah, things are kind of ducky. Actually, they're not bad as things go. We're in the middle of the summer. I'm still kind of buzzing from the Alaska vacation and all the consumption. Lots of consumption, a lot of conspicuous
That's right.
consumption, which makes me happy. Makes me think that Americans are feeling good. But the stock still can't break out. More to the point, to the reason I assume people are
Yeah.
wanting to kind of tune in here. Discretionary is still kind of just doing that slog. You can look at this chart one of a
You,
couple of
you say
ways.
they still suck, is what you say.
Well, that was indelicately put, perhaps by me. And in retrospect, maybe I would use a different adjective. But there's a certain sucking sound. There's a certain slurping going on,
Okay.
and it's hard for them to break out. We're in that moment before earnings where it's really easy to second guess this, and it's really easy to be concerned for a lot of reasons, mostly having to do with just the disproportionate sort of risk being borne by these consumption stocks, it's consumer discretionary stocks, with all this tariff stuff going on. And I hate to keep harping on it. It doesn't seem to matter. The bright side of this stock we're looking at, the chart we're looking at with consumer discretionary, is that it hasn't broken down. We have gone back to Liberation Day levels, but people are a little skeptical now, and that was 25% below. The downside of this chart is it's super hard for us to move much higher until at least we get some clarity, and clarity doesn't seem to be on the agenda right now anyway. So you end up having a disproportionate. Even I paid attention to CPI today, which I am not normally someone given to that. I think the monthly data is a lot of crap. I think it's really adjustable. But it's which is to say, if you're dealing in like,
I love the adjustments after the fact.
right, because it's you're micro analyzing this when it comes out in terms of like basis points. So 3% was higher than 2.9, and we're worried about that, but it could be 3.3 next month, and we won't really pay that much attention. Although at this point, we're starting to see the tariff leak in a little bit. You and I have talked in the past about what the companies had to do and how they were adjusting their shipments to take advantage of this pause. That period's coming to an end right now. And so we're really taking eagle eyes. The dismal scientists out there, the economics types, are looking at this data, and they're seeing inflation kind of incipient. It's bubbling up. It's not terrible. High since February. February wasn't that long ago, but it wasn't yesterday either. That's not so good. You're seeing it in clothing and furniture. Those are two groups that furniture is almost all produced overseas. Clothing, also same thing. You're seeing that tick up a little bit. Services is something we don't talk about, and it's not really a tariff related point. It's more to the point of ICE. I perhaps have a little overemphasized view of this because I live in deep Southern California, where a lot of the service type employees are making their way up north, and it's not really a cultural problem until you have it become really hard to get past the borders. That's being impacted. We're seeing that just as you would expect with rising inflation. You have fewer service workers. It costs more to get them. It could be until the end of the year because we delayed all these things till August. And at this point, August 1st is our deadline. We'll see. We've had deadlines in the past that got chucked. August 9th is the big kahuna in terms of China. And that's really the one hanging out there. A lot of what we're going to see in terms of how this data matters, it comes down to how harsh we get with China, not just in terms of the tariff we slap on them, that'll be the headline, but in terms of the way China goes about, if you make shoes in Vietnam, you're still getting some of your core inputs from China. And depending on how harsh the Trump administration chooses to get on that entire process, it could be a problem. Bottom line, though, is this was a tough morning for folks who are looking for Fed cuts. It's a little bonkers to say that, with Bitcoin at 123, we are not exactly wanting for action in these speculative asset basket groups. So looking for a Fed cut seemed a little unrealistic before, but if you have inflation, that puts the bat on their shoulder. It's any Fed chair worth his salt who's not just going to get into being bullied. I understand why the president would like them to cut rates. They're not going to cut rates if inflation is higher than expected. And in fact, they wouldn't be cutting rates in this environment with stocks near all-time highs unless it was much lower, and that isn't what we saw.
All right, but bottom line, though, you're in the camp with a lot of people, which is that we probably haven't seen nothing yet in terms of pricing impact from tariffs. So call me in a few months, I guess. I don't know.
Well, but here's the thing: like we can do better than that, because this is what I actually do for a living. So it's let's we can break it down a little bit. But the bottom line is we can call you in a few months. The inflation, the good side of it is that we haven't seen it go straight through to prices. And so the retailers have, in fact, been able to go out and negotiate a better deal, which is like, the administration's wet dream. He would love Walmart to get on the phone with China and say, hey, we're Walmart, stick it in your pie hole. We're not going to pay those, and you guys are. It's because it really comes down to who pays the tariffs. And the answer is consumers, vendors, and the companies themselves in some sort of mix. And so we're not seeing it inordinately hit the consumers, and we're not necessarily yet. This is where the earnings season is going to be so interesting. Seeing the companies themselves really get hammered on margins. And those are going to be the two things. Either, margins are going to get hit to some extent. So we're either going to be paying higher multiples for stocks, or we're going to be paying less for stocks. The latter is much more concerning if you're actually an investor.
All right, before we get to the earnings, let's talk about last week. It was
Sure.
your Super Bowl. One of your Super Bowls, I guess. It was
one of my Super Bowls. One of my majors. I do 4 a year, just like the golfers, just like all great champions.
Yeah, one of your majors.
For my majors are well, this is one of them: Prime Day, Christmas, Easter, back to school. Those are the big four.
Yeah,
back to school is kind of the PGA. It's a lesser major, but we still count it. It matters a little bit. Anyway, Prime Day, made up holiday. It's the ultimate discretionary. I love things that people really don't have to do. The hyper discretionary. I talked about them in the column last week. Stuff that you can't even justify. I just went out and bought a finger spinner. We're going to Vegas for the weekend. You're not making an economic argument for that. You're just kind of like, I'm feeling a little flush. I'd like to throw some money away. And we wanted to see Penn and Teller. Prime Day generally falls in that category. It's a holiday they made up 10 years ago to sell Prime subscriptions, memberships. It worked really well for that. At this point now, Amazon, they're become so powerful that now every major retailer has a summer event. Target has turned this into effectively the start of back to school, which, depressing as hell. You're a parent. You're about 5-6 years from that becoming just a happy but a little bit sad thing. They were starting back to school the first week of July now. But that's what's happened. Anyway, the results from Prime Day were huge. People are complaining and whining about the data's not great, as if a holiday made up 10 years ago should have really robust kind of data. But the spending for Prime Day the entire week was up 30% online. That's a huge deal. That's like 2 Black Fridays. That's which is the period before Christmas when people actually do shop. Just out of nowhere, just created out of ether, we're able to generate spending with discounts that averaged about 14%. So really good, which is like a bowl of soup with that hat, sir. Type of inducements to buy things. They didn't have to go deep on discounts. They were still able to kind of generate that level of sales. It's really good. Amazon's behaving well for a reason right now. I think that stock goes back to all-time highs. The other name that we talked about last week was Levi's, which turned into a nice little trade for Daddy and hopefully Daddy's newsletter readers. We all won. Everyone wins, Spencer. And who likes everyone winning more than I do? No one. So they reported, but really terrific numbers. And this might be the model. It could be the prototype of companies that are kind of sneaky decent investments in this environment, meaning they supply globally, pretty much everywhere. An ancient company, whereas before that would mean that they were kind of static and having a hard time really getting any traction. Now that's fantastic, because if you're manufacturing done, you want it to be in every local market, because that saves you just a ton of time and tariff adjustments. They reported terrific results. They are kind of Michelle Gass, who ran Kohl's, not particularly well. I don't think that was entirely her fault based on how Levi's is doing, but she's got that company turned in the right direction, and they filled the gap just like we said they would in the newsletter, and it's kind of holding the high. So that's pretty good. And it's also the other interesting thing. Levi's is now making athleisure jeans, which weird, but we're seeing kind of a switch back to a little bit more traditional clothing style. That makes it tough for Lulu in terms of their comeback, but maybe Levi's takes a little bit of that share. Levi's is a smaller company that people think a lot less about. So, I'm still long a little bit of that trade, but that worked out pretty well. So, better to poke in the eye with a big sharp stick, although the clouds are still forming.
And a 52-week high off this report for Levi. So not all-time high, but 52-week high is not nothing. So
yeah, it's a really old company. We don't need all-time highs. It's just nice to let's take what we can get.
Nice pop, and as you note, it is holding on to those gains. Let's talk about tariffs for a second. Can you maybe just update us on what's been happening? But
this is Professor Mackey's wonky corner. I don't want to get too far into the weeds here. We can simplify it. We talked last week about how this was going to, that was the supposed deadline, right? We had July 2nd or 9th, whatever it was. It was ignored anyway. But that was going to be when we really, came to grips with this tariff. Instead, it became just a series of letters announcing one by one kind of draconian tariffs that were crazy and a little high and more or less back to where we saw at Liberation Day, as I alluded to before. Here's why it matters, though. You see those, you can circle my scribbling there, and we'll post these slides later for folks to go through a little more. But that's the on your up and down axis, you've got the profit margins by industry, and going to the left to the right, you've got the impact to margins from tariffs. And so what you don't want to be is really low on the graph and far out to the right, which is exactly where you see
that's exactly all right. Automotive and consumer retail and industrials. Got it. Don't want to be any of them.
Yeah, you don't want to be them. And holy crap, it becomes even worse for the retailers, because those are the cudgel. Those are the big hammer. If you're negotiating on a national level for Americans, what you want to have on your side are the consumer dollars, because as I mentioned before, we're the best damn consumers in the world. Now that just sounds like jingoistic hype. I'm not above jingoistic hype, Spencer. In fact, I embrace it. I love it. And I love it, especially when the facts are on my side. Go to the next slide and I'll show you what I'm talking about. We're just the best. It's per capita spending. So you break it down, you say, oh, you're a big country, big deal. We spend more than the Swiss. My son is in Switzerland, or just happened to be on a little bit of a world tour. He's doing his thing and just kind of being a kid. He's like, you can eat off the street. He says, if you leave your wallet on the table in Zurich, someone will have returned it to the post office with all the cash in it by that afternoon. It's just a bonker socialist state where they consume everything and they do nothing but banking. We outspend them. God bless America, man. Let's get the chant. But the other thing, and here's where it becomes a real problem, total consumer spending, America at 18.8 trillion. Nearly 70% of GDP. We've mentioned that stat before, but that's an actual real number. We're more than twice as big, and 2.5 almost as big as China, and way bigger than Germany. And after that is just a cluster mess. So if you're negotiating this tariffs, this is the axe you have. This is why the retailers are part of all of these tariff conversations, because they have to import the products and the goods, because that's what foreign countries want with us. No one wants to put up with this sort of mad king erratic behavior, but other countries will, because, man, 18.8 trillion is a really huge market. And if you're selling T-shirts or shoes, or you're producing any of that stuff, that's where you want to sell them right now. And so you still have these companies on the front lines in terms of they're the least qualified to be there because they have the lowest margins. They make almost nothing for sales. But man, that 18.8 trillion is what America has to deal with. It's both a source of pride and a little bit of an Achilles heel when it comes to negotiating. So we'll see how it works out. Ideally, we could carve out, Americans don't need to be making T-shirts anymore. That's not the industry we want. That's not really a national security risk to us. But the reason that the retailers are still in the conversation is because it's 70% of our GDP, again, which is 50% higher than the next closest competitor in Germany.
Yeah, we have the most exposure, so we have the most to gain and the most to lose, right?
Yeah,
Bottom line.
yeah.
All right,
It
let's
sucks
talk
to win.
about.
Every once in
Yeah,
a while, it's a tough. It makes it hard if you're going to be winning. But not that there aren't alternatives. Not that there's not places we can put our money. It's we're just going to shift it a little bit. We're going to do that two ways. One, we're going to expand what's meant by consumer stocks, and the other is we're you'll see it in the portfolio. That's a teaser for folks who subscribe, as everyone should, if they want to get the top notch idea flow. But we're moving into services. One thing that we've seen, the Europeans for some reason are a little negative on America, a little harsh to us right now. It seems unfair. I mean, come on, we're not bad guys. Who's a bad guy? Not us. It just seems crude. It seems like they're kind of painting us all with a big brush, when a fine tooth quill would be finer. But you know what? That doesn't matter, because some of our best global companies are both tariff proof, at least for now. I'm not trying to give anyone ideas, but also have just tremendous business models. Companies I talk about all the time. Netflix reports this week. Many call them the Spotify of America in terms of a subscription service that no one's going to give up. Uber's a name that I mentioned over and over again. I just bought some of that in my personal account. These are companies that are insanely well positioned, but they're also a little bit immune to the vicissitudes of the travel situation right now. We're seeing less international travelers. We're seeing Americans pick up the slack to a degree in terms of travel. So it's not just a disaster on the travel numbers, the recreational numbers, the consumer numbers. But I like this global exposure because Uber exists all around the world. Netflix exists all around the world. One of the big metrics you're going to see tomorrow is going to be their global subscription growth. And it's going to be terrific.
Well,
so
let's talk about Netflix. You
yeah.
mentioned that they report earnings. It's Thursday after the close,
Yep.
which is unusual. I feel like they're usually on a Tuesday or Wednesday, but neither here nor there. So Thursday afternoon, they are the first of the modern mega cap tech stocks to report this earnings cycle. Not that that means anything. It's just they're the first ones on the calendar.
Yeah, companies that people give a shit about. I don't understand financials. The banks can report anything they want near as I can tell.
People care about the banks. So the banks are going to be done with by tomorrow or Thursday, right? So then
boring people.
So
care
Netflix.
About the banks,
so the first of
the
the first of the big sexy reports. What are you looking for here?
You're looking for sub growth. You're looking for reaction. I mean, these guys aren't absolute machine. They when things can't get any better than they are right now, and that's really kind of the case for Netflix. I mean, the chasm between Netflix and what everyone else is doing on the streaming side just continues to grow. I will subscribe to two services and never give them up. One is Netflix, which I feel like I'm in really good company there. The other is Peacock, which I don't know if you've been watching the Tour de France.
Nope.
Like so many people. It's I can just feel kind of the collective excitement build every morning when we watch Pogacar. But anyway, so that's more of an eccentric taste. But the one thing that people will not give up is their Netflix, and they're expanding that lead. They're doing it through a lot of different ways. One, they produce kind of original film content faster than any company extant, and will continue to do so. Cheap things like dad documentaries and stuff. The other is through live broadcast. They're going deeper into sports. We'll get to alternative companies' ways to play this away from Netflix itself, which it's up 94% over the last year. Not a huge secret that Netflix is doing well. Not a big brand new fresh idea. But so what I'm looking for really is the reaction here. I don't expect them to miss on subs. I don't expect them to miss on anything that people are going to care about. What I expect is really solid numbers and maybe a little bit of a pullback. But I also know, just in terms of experiential kind of what I see when I'm out there, I was watching women's boxing on Friday, and my Twitter stream was just full of people talking about this Netflix show. Entire fight card. As a longtime fight fan, Spencer, it's not normal for folks to watch boxing in any kind of numbers. It was the type of thing that happens every 6-7 years. Netflix has turned that mainstream, and they're going to keep spending money on that. It separates them from really everyone except Peacock. But I would argue that maybe the NFL and fights and WWE are probably have more broader appeal than the Tour de France. Even I hate to say so, but that might be true. So, I'm looking for Netflix to expand their lead. I'm looking for good sub numbers. I'm looking for the advertising business to do well, but so is everyone else. I'm not sure there's an edge on this trade. I'm super happy we got long Spotify. If I saw a dip on Netflix, we're going to buy that dip in ways that will break out in the newsletter. But, I'm more focused on related names.
Well, let's give the people a related name. And this is TKO. So this is the owner of UFC. It was the merger, right, between WWE and UFC, and they rebranded, and now they're TKO. And it's kind of the same idea. It's a content play, live events, and clearly, I mean, I'm actually quite surprised to see the stock doing as well as it has been, but it's been pretty good.
It's been a terrific stock, and it's one of those names that the corporate structure isn't great. It's Art Emanuel, the super agent. If you're buying stocks that are run by a guy called the super agent, you can more or less assume he's not giving the best deal out to shareholders. You don't get to be the super agent unless you're really kind of going to take the bulk of the cash for yourself. That's how you become a super agent, is doing that for yourself and your clients. But he's also not going to run a failing company. He's a super sharp guy, and the UFC acquisition, the WWE acquisition, incredibly smart. Both for a couple of different reasons. Those are two sort of shaggy dog type of businesses that they were able to clean up really in easy, obvious ways. You get rid of the McMahon family that's been just running the WWE in a kind of, shall we say, insular way for years and years, but you took care of a lot of lawsuits there. And UFC is really the same thing. And UFC, even without any really great championship rosters right now, the numbers are still incredibly solid. WWE, you can see John Cena there, Gen X hero, the last great generation of athletes, the 45 to 60-year-old group now. We're still carrying the torch. Looking for Phil Mickelson to be strong this weekend at the British Open. John Cena's on a championship run. Greatest athlete in the world is, of course, traditionally the WWE champion. John Cena's holding the title. So people are excited. There's a lot of buzz. There's a lot of chatter. Even with notwithstanding the chatter, I'm looking. TKO's a name I've been long for a while. I kind of feel a little squeamy about it, but it's not a name you hear really at all with this Netflix, but it's very much part of the revolution, which is live content. And the advantage of live content for the streaming companies is, again, that cultural relevance. You can dump Black Mirror episodes on and you dump them on, but there's no conversation about it. There's no chatter. There's a real leverage when you can get people to watch, say, WrestleMania, which sounds crazy, but people do it, or a UFC event, wherever they choose to stream it. Folks in the social media sphere will talk about it, and that creates its own kind of synergy, its own energy. And it's obviously appealing to Netflix. It obviously works for Netflix because they do nothing but keep expanding it. And there's signs that it works. So if you're looking for a way to play Netflix into their number, I would suggest not doing that and looking more to kind of a TKO or something that while still expensive, is a little less hyped and really plays and benefits from the strengths of what Netflix is doing.
All right, everyone, listen up. If you want to get or find out what stocks are in Jeff Macke's portfolio, the only way to do that is to join Macke's Retail Roundup. The link is in this description on YouTube. If you're watching it on our site, we'll put a link in there as well for that. And if you're watching on YouTube and you don't get Jeff's free note, the link is right there. Get the retail report. Goes out several times a week. It's Jeff's thoughts on everything from Prime Day to back to school shopping, tariffs, whatever's on his mind in the world of retail.
Many savvy people call it a must read, Spencer. That's the chatter out there. That's the buzz. I've got my finger on the pulse, and that's what I'm hearing.
Jeff, thanks as always. We'll see you next week.
Absolutely.